Welcome everyone to this week's episode. Today we have a special honored guest, Des Meyers. Thank you for joining us today, Des.
Oh, great pleasure.
We appreciate your time. Just before we begin, I'd just like to state that the views and opinions given in this interview are that of the individual interviewed and not necessarily the views of AfriFocus, and investing in the stock market is by its nature risky. So yeah, Des, thanks again for joining us. Welcome to the show. So yeah, let's kick it off. If you wouldn't mind maybe just giving us a bit of an introduction to yourself, tell us a little bit about yourself and your history on the stock markets.
Okay, it goes back quite a while, of course. I studied accountancy back in the 1960s, and then doing an audit of one of the companies that I was sent to do the books on, I founded an investment company that this particular client was dealing in the market, and I thought this was a little bit more interesting than just writing up books of accounts. So in 1966, I completed my articles and was basically just about the end of my studies. And then I decided that, yes, I'll finish my studies, but what I'll do is I'll go to the stock market and went to a firm of stockbrokers and went in on a daily basis and watched on the Reuters ticker how prices were coming through. And I said, well, this looks like a great place to be. And that was the latter half of the 1960s. There was a huge boom in the market between 66 and 1969, and that unraveled ultimately into a major bear market, probably one of the worst bear market that I've ever experienced. And certainly that big up and the big down taught me a lot about the market. And then I joined a London merchant bank, a local London merchant bank in the 1970s, looking after pension funds and individual portfolios. And that's where really the history all began.
Wow, sure. So many years experience, and I'm sure you've got a lot of scars and a lot of good times as well.
Both. You only learn, and in fact, I say to my colleagues here today, after how many years that may be, it's already something like 56 years, I learn every day, something new to be learned every day.
So even after 56 years, you still learn.
Absolutely.
That's fantastic. Well, we certainly appreciate having someone with your vast experience and knowledge on the show, and we can only learn from you. So thank you again for being on the show. So yeah, let's maybe just find out from you, Des, where do you see global markets going over the medium to longer term?
Well, we've reached, I think, a very, very critical juncture, in the sense that if we go back over a long period of time, we've had big bull markets, we've had bear markets, and the nature of the cycles is that after a very pronounced bull market, the authorities have generally had to start to clean the system. Effectively, when interest rates are very high, very low, I should say, they start to increase interest rates to put pressure on corporate, not to intend or pushing pressure on corporate profits, but rather that pressures are starting to exert themselves in a maturing bull market, and share prices come down. Now we're looking at, I think, something very different. I think it started with the global financial crisis going back to 2007, 2008. We had all that printing of money, quantitative easing, and that worked very nicely. It worked right through till most recently. And then we had the COVID crisis. And then you had a renewed form of money printing again, without having cleansed the system on the previous excesses between 2009 and 2020.
Yeah, that's quite an interesting point to make it, because the system didn't get a chance to go back into a normal inflationary cycle, and the monetary authorities raising interest rates significantly again.
Absolutely. And that has left us today in a very dangerous situation. I think that the danger really is the level of debt. That, to me, is the biggest problem the world faces economically today, is the excessive level of debt. And that's why we're facing a situation where the authorities are going to find it very difficult after delaying, procrastinating for such a long time to cleanse the system. I think it's got to a point now where it's too late. And that is now going to have some horrific consequences, because we should, with the inflationary pressures building again as a result of various factors that have crept in over the last year, 18 months, oil crisis, just as one example, and shortages of various materials. We've seen huge rises in prices of various commodities, and that's clearly starting to move into the system where inflation is going to become a problem, and the authorities should be increasing interest rates, but they can't. They won't, and they can't. So what happens out of all this now? They face a major dilemma. Markets are high. Corporate profits are running very well indeed. Enormous wealth has been created in markets. That one is, it's plain to see. But how do we cleanse the system, particularly now with inflation starting to become a major problem? People have said to me, are we going back to where we were in the 1970s? 70s was a period of stagflation, inflation increasing, no growth or negative growth. And the risks are we're going right back into that kind of scenario. And in that particular scenario, we had a major move in the gold price. It started when Nixon closed the gold window back in 1971. The gold price under those circumstances went up from $35 to eventually to $200, came back again to $105. That was the peak was in late 74. The ultimate, the low that followed was back in August 76, back at $104. And then we had pressures from the oil price. We then even had the Russians invading Afghanistan, with the result that gold price found its way all the way up to $850 an ounce back in the early part of January 1980. And by the middle of 82, we were back again under $300 an ounce. And the more recent times, back in 2001, gold started from a low of around $200 an ounce, found its way all the way up to $1920 in August 2011, came all the way back subsequently to 1,050. Well, I'm mentioning all these figures because I think it's extremely relevant today to look at what can happen to the gold price under circumstances where the real cost of money starts to come down. And that's what we're seeing today, is the real cost of money is coming down, meaning that interest rates are too low relative to the inflation rate. And that is the dilemma that I think we are really facing today.
So, okay, so you basically answered my next two questions, which is what are your concerns and where do you see opportunities in the markets? Clearly, your concern is that there's going to be runaway inflation.
Well, it's certainly a high level of inflation. Whether we'll have a runaway inflation, I don't think it's going to be that serious, but serious enough to create a lot of problems.
So I'm just curious, what you said that the monetary authorities cannot raise interest rates. Well, why can't they?
The debt is too big. The level of debt at government and in the private sector, particularly in the government sector, is too big. The level of debt, they have just been printing money. The balance sheets of these central banks have gone through the roof. And it's got to a point where I don't think they've got the, there's just no chance of them pushing rates to a level because it'll break the system. The system will basically collapse under the weight of rising interest rates. Sure. So we're looking then essentially at negative real rates of interest. It's a terrible scenario for savers. It is soul destroying for a saver because previously, if you had an inflation rate, let's say of 4, 5, 6%, you got an interest rate of 8, 9%. You got a real rate of return of a couple of percent. You could buy shares, you could get dividends. Now, because the market is at such a high level, dividend yields are down at, I'm talking about globally, down at 1, 2% and maybe below. Large share here and there, 3%. So people who are looking to their investments for an income have been destroyed,
But then I guess they've got no choice but to invest their money in the
Yes.
market for capital appreciation as opposed to income from dividends.
Yes. Now, that's the reason I think that no matter how high the stock markets are, unless there is an exogenous, you have to change, exogenous event, we will not see the markets buckle dramatically. I doubt it very much. We get another COVID kind of issue creeping in, markets will break, but I don't think under economic circumstances that will force the markets down dramatically. It will result in a major fall in the market. So where are people going to go with their money given this kind of situation? And that's why I'm very bullish on the gold price on the longer term. That's real money. And the best friend of gold is basically negative interest rates, negative real rates of interest, which we saw back in the 1970s. So a repeat of a major rise in the gold price, I think, is very much on the cards, but it may be delayed. It may be delayed for another year, 2 or 3. We don't know. We don't know exactly what the trigger will be. And the most important thing, one of the most important things, there's very, very little interest in gold today. Very little investor interest. There's a lot of buying of gold by the central banks in the East. They've been big accumulators of gold. The paper gold that's traded in the markets that we are familiar with on a daily basis, that's keeping the price at the moment under some kind of creating a ceiling for the price. But that's not going to continue. The physical demand will ultimately drive the paper market eventually higher, and you'll get a whole host of investors starting to come for gold again. Institutions, we know the local institutions in South Africa, very few have got any interest in gold at all. And I think that goes for the major investors overseas as well. Very, very little interest in gold. So it's another market that I think has got huge potential because there's no interest at the moment.
And is that not because the reason why there's no interest at the moment is because the thesis at the moment is that people think that the Fed and other central banks around the world will raise interest rates, making, for example, the dollar more attractive and stronger, and therefore the gold price weaker.
I think you've got a very good point. I think, pleased that you brought it up, because that is certainly a thought that I think is very, very pertinent at this time. People believe they are going to raise interest rates, but not understanding that they cannot do so significantly because of the debt burden that we are experiencing.
It's so big.
It's so big. It's so big. And just another point I'd like to make on the gold market is that the shares, the gold shares, today are offering very decent value with a gold price at, $1,750, $1,800 an ounce. The costs of mining, while they have increased, considerably since the 1970s, of course, the costs generally we call the all-in sustaining costs are around $1,100, $1,200, $1,300 an ounce, and sometimes less. So you've got a very good margin for these mines to operate with. And there's been very little new exploration taking place. So I think the chances are that the gold price go higher, and with these margins that the companies are making, they're going to be in a very strong position to pay significant dividends. So imagine the gold price goes to $2,500, $3,000 an ounce, which I think is certainly a realistic forecast. These mining companies, gold mining companies, will be making huge profits, and they've got very strong balance sheets today. Very few of them carry any debt. So they are in a very strong position.
Very interesting, Des. So if you wouldn't mind me asking, on the JSE, we got a bunch of gold miners listed: Anglo Gold, Goldfields, Harmony, DRD. Is there any one of those that you prefer over the others, or would you advise people just to go into all of them?
I think a spread of the shares is fine. Institutional investors probably will favor Anglo Gold and Goldfields, but I think to have a few Harmonies, some DRD Gold and Pan, and one or two others is absolutely, I think it's absolutely fine, because you can never point out pick the exact stock that's going to perform. So if the sector is good, have a spread. I think it's absolutely fine.
All of them will benefit. And
yes, considerably.
I guess there are some of those we kind of forget about. Pan Africa Resources is one of the smaller ones that we don't often think about. I think Sibanye-Stillwater's got a bit of exposure to gold.
They've got pretty good gold exposure as well. You remember the old Kloof and Driefontein amongst the mines that they own. Those were very, very rich mines. They're not that rich today, but there's still something good around there. And by the way, DRD are now extracting gold from those dumps. And those dumps have got pretty decent grades of gold compared to the dumps that are south and east of Johannesburg. So DRD are going to be in a very strong position to significantly improve grades and a huge extension of life from those new dumps that they're tackling.
And they've got no debt from...
And no debt. They're sitting with over 2 billion in cash to expand the Far West operation. And therefore, I think the deal that they did with Sibanye going back, I think it's 3 years ago, was a real game changer. A real game changer.
Brilliant. And I guess with Sibanye, you've got exposure to platinum, and
of course
now they're buying these other mines in other metals as well.
Absolutely.
Very interesting. So thank you, Des. And then just moving on, just from a broader long-term perspective, or short-term perspective, however you said, what is the best way to make money on the stock market?
I think the best way, too many people have got very short-term vision, looking for 3 months, 6 months, a year maximum. My experience has told me to invest in good assets, in companies run by very competent people, and most important, the management of companies must be on the same page as the shareholder. We've seen many companies where management look after themselves at the expense of shareholders. Find companies where the management have got the same interest as the broad spectrum of shareholders, and take a long view. Take a long view. Mistakes that I made along the way was basically whenever I took too short a term view. The better opportunities all came out of much longer term investments. Think of oneself as an investor in a business, not a share price. You are investing in a business, and if you invest in a good business run by competent people over the longer term, you will do very well.
Absolutely. Yeah, definitely the theme of patience has come through.
Absolutely.
From the other people I've interviewed on the show, and that certainly does seem to pay off over the years, I guess. And in time also, you have things like unbundling and the accumulation of dividends.
Absolutely.
Perhaps a company buying another company, or another company making an offer for the company that you've invested in. So I guess that's really where the opportunities come for the long-term investors. But you have to be patient, and
got to be patient. And that flow of dividend is so very important. I can go through quite a few examples where if you've bought a share at where your entry price has been pretty decent, where the PE ratio has been modest, the dividend yield has been relatively high, and that company provides you with a growing dividend year in, year out. Ultimately, those flow of dividends will far exceed the cost of the shares, far exceed the cost of the shares. And that's where wealth is created.
Absolutely. But I guess it would also be nice if you had a little bit of cash on the side, in case there is a bit of a crash in the market.
Always have cash on the side, no matter what is happening, and more so when markets are high. Take something off the table so that you are basically in a position to participate when and if markets fall. always never be in a position where you have to be a spectator. You be a spectator, great to be so under your choice, but never to be that way when it's forced upon you. And having a cash resource is vitally important.
And I guess where we are right now in the market, so things certainly are not cheap. So
Absolutely,
maybe right now would be a bit of a time to take a bit of cash off the table and accumulate a bit of a reserve for future opportunities.
Absolutely. There are many shares today that are very stretched today from a valuation point of view, and no harm done in taking some money off the table. You may be very happy with the company longer term, keep a core holding, but take something off the table, build the cash so that in setbacks, you are there to profit out of that opportunity that comes your way.
Absolutely. I couldn't agree with you more. Well, Des, thank you so much for joining us today. I really do appreciate your time and sharing some of your pearls of wisdom that you've gained over, what's it,
56 years.
56 years.
I'm hoping for at least another 10.
I'm sure you'll get there, Des, and we look forward to having you around for maybe some more wisdom to share with us. But thank you so much again.
It'll be a great pleasure.
And if you have any questions about this episode, you're welcome to contact me at AfriFocus. My email address is warren.s@afrifocus.co.za. That's warren.s@afrifocus.co.za. Or you can leave comments down below and subscribe to this channel if you like. And we will definitely see you next week. Have a fantastic weekend. Thank you for joining us.